Hello.
And there it is. We are officially live. Welcome, welcome, welcome. Welcome, Facebook. As you all know, my name is Letitia Grant. I am the chair of House, Then the Car. So we'd like to thank you guys so very much for joining us this afternoon for Super Series 3. We're already on Series 3, and this is episode 2 of All Hands on Deck. And this show's title is One Stop Shop. So, House in the Car is absolutely a one stop shop for you. Again, my name is Letitia Grant, and I am your House Then the Car chair. And of course, we're joined with our campaign manager.
Hi, good afternoon, everyone. My name is Stephanie Milburn. I am the campaign manager for House in the Car, and welcome to our Super Series Tuesday.
Now, guys, last week she was going to join us, and first of all, I want to tell her something. I want to tell her happy birthday, Miss LaTanya Donaldson. And then we get online and I find out that, all of our birthdays are within 30 days. Now, Tom, I don't know about your birthday, but I'm just going to say we're going to party like it's 1999 today on this Zoom. So just FYI, if we get a little too excited for you, don't worry about it. Just disregard it.
Sounds good.
But welcoming back to our virtual stage is Miss LaTanya Donaldson of Prime Lending.
Well, thank you, Madam Chair. I really appreciate being back with you. You know I love co-hosting with you because we have so much fun. But I'm LaTanya Donaldson, Vice President, Director of Multicultural Lending for Prime Lending. And as I said, we're so honored to be here co-hosting with you. And I am so excited about today's topic because I love talking about credit.
Oh, good. Look, I know. I'm like, okay, this is just perfect. I'm always excited, first of all, to have you here. Second of all, it's always exciting when you know it's a topic that someone is enthusiastic about, because that's just going to bring the crowd and that's going to bring all the energy that we needed to bring for today. That's I want to give everybody kind of like a little warm intro, talk about this session. During this session, we'll specifically speak on credit challenges and the effect that it has on the ability to obtain an approval. And by approval, I mean approval for a loan. We all know that credit challenges do not happen overnight, and that a low credit score is a true indication of a low budget or lack of resources. So with our panelists today, and of course we say it's all hands on deck so you guys can see our deck is full. And the reason why we're showing you everyone that's online today is because we want you to know every session our deck will be full and why it is so very important for that to be full. But I won't delay the process. Let's go ahead and let's dive into our introductions.
Well, welcome again, everyone. And I would like to introduce our guest, Mr. Thomas Quinn. And Mr. Thomas Quinn is our Vice President of Scores at Fico. Currently works with Consumer Direct Partners to help integrate and distribute FICO scores features within the consumer credit empowerment initiatives. With over 25 years experience at FICO, Tom has an established history working with consumers, regulators, legislators, lenders, the media, and other industry entities to help them better understand the power of credit scoring technology and its benefits to the financial industry and consumers. Tom, thank you for joining us today.
Thank you, Stephanie. Looking forward to it.
So I get the opportunity to introduce the beautiful Miss Marlena Scott. She's a single family client and community engagement manager at Freddie Mac. She is responsible for managing and developing industry relationships. She is committed to bringing awareness to Freddie Mac, offerings to support responsible lending, provide sustainable home ownership, and to provide access to credit for all borrowers. Marlena has over 14 years of experience in the financial industry. She began her career at Bank of America, where she spent 8 years, and in 2014, she joined Freddie Mac. Marlena?
Thank you so much. I'm glad to be here today.
Yes, good deal. I'm so happy to have the both of you on here. I think we often separate credit from budget, and
Mhm.
people forget that they go hand in hand. So that's why I'm excited to have both of you here today. So when we talk about bringing all hands on deck, Marlena, let's talk. Let's talk
Yes.
about it.
Yes. I'm ready.
Latanya, go ahead and open us up.
Yeah, so my first question to you, Marlena, what items must an individual collect in an effort to prepare a comprehensive budget? And
Yeah, well, that's a great question. So again, thank you for having me. But some of the things that are important when coming up with a budget is, first of all, you kind of have to leave your ego at the door because it's going to be a piece of humble pie. Most people don't really know exactly what they're spending. And poor money management is actually one of the main reasons of financial difficulty. So when you're coming to the table, you want to know exactly what you're making, whether you're salary or hourly, you want to have your pay stub on hand. You also want to have a list of what your fixed expenses are. Fixed expenses are your house, your rent, your car, your utilities, because they happen month over month, childcare, all of that information. The next thing, if you're carrying any sort of debt, you want to make sure you have your unsecured loans, your credit card statements. And then unfortunately, the big challenge is student loans. We want to know how much you're paying for your student loans, and really understanding, how the longevity of this debt load when you're considering your budget. And then lastly, which people don't really think about, is that bank statement. There's a lot of residual spending that happens that you may not think of that adds up and eats a large portion of your budget.
Yes.
Yeah.
Marlena, how often is it that you come across a situation when the individual's expenses actually exceed their income?
So I don't too much come across that now just because I'm not on the credit side anymore. But when I was, it was very often. You actually would see people supplementing their income with their credit card spending. So that is something that people don't think about. And then there was a recent study, and forgive me for not knowing the name of it, but it took into account people from all various income levels and looked at how much money they actually had left over for groceries, for things after they made their payments for their guaranteed expenses. $400 was left over. And so when you think about groceries, emergency bills, a car, that needs to be repaired, that's not a lot to be left over. So if in this situation, you may be living outside of your income.
Marlena, go back to the original question when we were talking about personal budget. Okay, because we have our personal budget, and then we have what we refer to in the mortgage industry as DTI, which is debt to ratio income. Can you explain the difference in those two?
So the personal budget is taking into consideration all of your expenses, all of the things that you have. The debt to income is really only focusing on the things we can visualize on your credit report. So utilities wouldn't be taken into consideration. Getting your hair and nails done is not in the debt to income. So that is a little bit different. Child support, exactly. Yep.
Yeah, exactly. And that's a great question and a great point to bring up, because a lot of people do not know the difference in that. I know when I was originating, right? So, we come up with a DTI or a debt to ratio income, on products, you might hear, oh, you can't exceed like a 38% backing ratio or 40 or whatever. And you might be right at that. But I know one of the things that I would always advise my customers on, just because we're telling you can afford this house, only and that's why your personal budget is so important.
It really is, because it sets you up for success.
Right.
I mean, if you don't know what your whole financial picture is, then getting into that home is only going to cause you to have a little bit more pressure on you as far as your living, your lifestyle.
So should we consider a budget to be a financial plan?
So I think a budget is part of the first step into financial planning. I know we're going to hear about credit later, but budget and knowing where your credit is really part of the financial plan. Then it kind of escalates from there. I think when people think about financial plan, they think you need to have a financial planner, and that's not the case. You are your own financial planner, and it's just trying to figure out what you would like to achieve. And of course, you know, working at Freddie Mac, we want you to achieve, and Prime Lending being a valuable partner, we want you to achieve home ownership, because that is what's important at the end of the day. In order to do that, you have to know where you're going. And you, not in just the short term, but the long term. So say you want to buy that home, and say you want to plan for securing your home for your building wealth for your family, because that's what home ownership is. It's building wealth for your family down the road. So maybe you want to think about life insurance. I mean, all of these things go into the financial plan, and budgeting is really just one of the most important pieces to get started.
Yeah, I totally agree with that. You know, I kind of think of financial planning is that first step toward generational wealth and building, as you mentioned.
Yeah. I'm actually really glad that Marlena made a very important point, is that oftentimes when people think about a financial plan, they associate that with a financial planner, you know, but ultimately, and we can't all afford, you know, to hire a financial planner, but we can't afford not to have a budget.
Right.
So having a budget is like your main key to success. And when you were talking, and of course, Latonya, I know you've probably seen this, when you guys were talking about the debt that you put, all of the things that you write down, the debt to income ratio versus your budget, the first thing that I thought about was probably one of the most costly things that we will pay for outside of a mortgage, and it's daycare.
Yes. Absolutely.
Yes.
That is huge.
That doesn't show up on your credit report.
Right.
But in daycare, the price of a mortgage?
Yes.
Absolutely.
Yes. I have seen it. Yes.
That's right. I remember, listen, it's been a long time for me, but back when I was paying daycare, I mean, that's an excellent point, Letitia. I mean, I can remember that expense was like over $800 a month.
Yeah.
So yeah, you know, so it goes back to my point of, you know, we will tell you, okay, this is what you qualify for in terms of a home based on your debt ratio income. But keep in mind, we're not including the daycare. And that is a very significant expense.
It absolutely is. Right. It absolutely is. You know, Marlena, when I asked the question, if you've seen often a expense budget exceeding the income, you stated that not so much so. And you know, even with the daycare, I know our millennials are waiting until later in life to have children, but we all have expenses that may not be as much as the daycare, but they are pretty costly. What is the advice that you would give to one when you've noticed that they're actually spending a little bit more than what they can afford to spend?
So I think a budget is a realistic kind of slap in the face, if you will, of you need to know what you are spending compared to what you think you are spending, because we have this idea that, oh, I'm not spending that much money. But when you sit down and actually look at everything, you can see that you're potentially wasting, you know, or, you know, overspending in categories, and actually see that your residual income is slim to none at the end of the month. So I would always suggest, you know exactly what it is that you're spending.
And I think one of those areas, eating out. I know that's fine. And my shoe budget.
Yes.
So listen, and I'm glad that you brought that up, Latonya, because before we launched Houses in the Cars, a virtual platform, we did a very small study. Now, and of course, I tell everyone all the time, a study is only as good as the information that you include, the individuals that you include in the study. But here's the thing. I did a very small study of individuals that are homeowners, that are not homeowners, and I asked that they pull their bank statements. Let's take a look at what you're spending money on, and you know, just kind of analyze it and prepare a real budget, not a fictitious budget. Because, like you said, Marlena, a real budget is when you've pulled those bank statements, when you've actually looked at what you're spending. And guess what? The number one wasteful expense was eating out.
Wow.
That was the number
Yeah,
one.
I believe it. I believe it. I think people need to learn how to cook.
Right?
Right now, that's my stress release. So,
I know, right?
I try.
right. No shade to people who don't cook. It's okay.
That's okay. But so we've spent a little time, we've dissected the importance of a budget. We've talked about the fact that you don't necessarily need a financial planner to have a financial plan.
Mhm.
And a very big piece of this financial plan is your budget. So guys, that is your budget takeaway.
Mhm.
Okay. Now we're going to take all of this information and we're going to move this over to the ability of you being able to obtain credit. Because at the end of the day, if you can't manage your money for yourself, you can't balance money to pay someone else back. And that's what prevents individuals from being able to obtain a loan, is because you can't even, or you're not balancing and monitoring your personal spending habits. So then the people that have the money to lend to you are looking at you like, well, I don't know.
The
Pro tip.
ability to pay is
Yeah.
what that's
That's it.
Yeah.
Mhm.
Well, Letitia, I'm so glad that you mentioned credit because we would like to bring Tom back into this credit scene. So we have Tom
The
here
women
from
take
FICO.
over.
Huh?
Did the women take over? Tom?
Just a little bit, but we're gonna pull Tom back in. So we're gonna pull Tom back in. So we're gonna dive into credit, and Tom is here with us from FICO. And of course, when dealing with home ownership, your FICO score 8 is what the lenders are looking at. So we want to go into this. And Tom, can you tell us about the FICO scoring model and when is it used for lending?
Sure, sure. So a FICO score is basically a three-digit number ranging from 300 to 850, where higher is better, and lenders use this score to help them make better informed lending decisions. So that if trying to understand if you're going to be able to pay your bills or not in the future is agreed. And I mean, I know a lot of people think that credit scoring is complicated and hard to understand, and it can be confusing. But at the end of the day, the score is really kind of just asking a series of questions and getting answers and assigning points to it. So, for example, let's say that Letitia today, a friend or a relative of you said, "Hey, Letitia, I need to borrow $300 from you today. Can you give me that money?" Before you would give money to someone, what would be some of the questions you would think of asking or wanting to know about that person and their request for $300 before you'd lend it out?
When you gonna
How
pay
long
me
is it going to
back?
take you to pay it back?
All right, how long it's going to take you to pay back? That's a good one.
I would want to know what your repay history looks like.
Right. So if you lent money to your niece before and has she paid you back as agreed? Other questions you may ask is, I wonder if she's asking my mother and my, stepsister, or if they're, so is she going out there asking a lot of people for that $300, or is it just me? So, when you think about money and lending money, and if it were your own money, before you give that out to a friend or relative, you're going to ask a series of questions. And the score is basically doing that in a mathematical or statistical fashion. And there's basically 5 key ingredients that the score is looking at. And when you think about them, I'll go over them in a second. I mean, they make logical sense. So the most predictive category of information is payment history. So the model's saying, hey, has this consumer paid their bills in the past as agreed? So we're looking at things like the recency of missed payment information, the frequency. So was it a one-time situation, or was there a pattern here of multiple missed payments? And then the severity of that missed payment. So was it a 30-day past due, kind of I was on vacation, I forgot to pay, and it's a one-time low delinquency occurrence, or is it a series of collections and charge-offs and bankruptcies? So, when it's looking at that delinquency information, it's really trying to tease out the factors that are most risky. So if you're have a lot of recency in your delinquencies and frequency and severity, that's going to be a recipe for a really low score. And that payment history accounts for about 35% of the score's value. And then the next category is what we call level of indebtedness. And so here we're looking at information on your balances on your credit obligations. So we don't look at income. That's a misnomer that people think if you make a lot of money, you automatically have a great FICO score. If you don't make a lot of money, you have a bad score. Income's not looked at in the model, but lenders may ask for that information when they're evaluating your application for credit. But we're looking at things like how much debt do you have? How do you have debt across your installment loans, like a car loan or a personal loan or a student loan versus revolving credit, like credit cards, and how much of your outstanding available credit's being used. So I've had many situations where I talk with a consumer on the phone that are complaining about their scores too low, and they said, hey, I never missed a payment. How can my score be 630? And I look at their report and it's like, well, you owe $100,000 on credit card debt. And so, yes, you've made payments, you're getting positive points for that, but your level of indebtedness is really high. And that's something that the model sees as risk. And then the third category is length of credit history. So lenders like to see people with long established credit histories because it makes them feel comfortable that the consumer had access to credit and manages it well. So that plays a factor into the score as well. And then the fourth category is what we call pursuit of new credit. And so here we're looking at recency of new credit openings, new accounts opening, inquiries. So if you're out there searching for a lot of credit, so those come into play as well in the score. And then the last category is what we call credit mix. And credit mix is basically looking to see, do you have a variety of different types of credit, like mortgage, installment, auto loan, revolving credit cards, department store cards, line of credit, home equity. And so in general, your ability to show that you can manage all those different types of credit obligations is predictive and results in more points. So basically the score is driven by 5 main categories: payment history, level of indebtedness, length of credit history, credit, new credit openings, and credit mix. And the real factor there is that your payment history and your level of indebtedness account for about 65% of the score. So don't obsess over an inquiry that costs you 5 points. Obsess over making payments and reducing the balances, because that's where you're going to get the most points to help you have a high score.
Tom, last week, I believe it was Stephanie that said, when you know better, you do better. And that was quite a bit of information.
Yeah.
Of understanding how the FICO scoring model. That's really a big thing. If the majority of your score or a large percentage of your score is calculated by paying your bills on time, that really takes us right back to our budget. Because if we can't afford to pay the bill, we can't afford to pay it on time, which results into a low score. Mm-hmm. So there's another hint for everybody to take back with them on the if you know better, you do better type thing. But Tom, I do have a question for you. We understand that it's important to have a good credit score. But what really, the term good is really relative. So what is a good credit score?
Yeah, that's a question we get quite a bit, Letitia. And I guess one way to announce is, beauty is in the eye of the beholder. And so each lender actually determines their cutoff on what is a good score. So there's not like one single universal, at this score you're good, at this score you're bad. And the way that happens is lenders can accommodate for someone, let's say, that has a lower score by charging a higher interest rate or putting some additional terms in the loan, but they'll still approve, the consumer's application for credit. At a very high general level, I would say that, having a score of 680, 690 and higher is generally considered good for most lending products like car loans and credit cards and retail cards, etc. And in the mortgage space, it's a little bit more well defined because you have entities like Fannie Mae and Freddie Mac who put out score requirement guidelines, FHA, the VA, home loan programs as well. And, the cutoffs that they use are also contingent upon down payment and other information they're looking at in the loan package. But generally speaking, if your score is between 620 and 640 or greater, Fannie Mae and Freddie Mac guidelines will consider that an acceptable score. And for FHA, it's a little bit lower, and it varies depending on what your down payment is, but it can go, 580 or even 500, and get access to the approval process. So, there's not one universal score out there, but you don't need to have a 850 to get credit. So if you are using credit and, in today's world, America economy is driven by credit usage. You can still qualify for loans with a non 850 score. So again, kind of in that mid to upper 600s and greater is considered kind of prime score lending by most lenders out there.
Here is what we want to, and I want to just take us one step back for our House in the Car audience. I see that we have quite a few people that are watching us live at this time. What I definitely want to say to everyone is we want you to understand that we don't want you to get extra points. We don't want you to get a higher or an elevated interest rate. We want your interest rate to be prime rate. So we're giving you the tools that's going to result into that.
Mm-hmm.
Letitia, we do have a couple audience questions for Tom.
Okay, and if give me just 1 second because I'm looking at the live and it looks like it's does it look like it's frozen on your end?
No.
Okay, maybe it's just my computer. Okay, go ahead.
Okay, Tom, Chuck has a question. He wants to know, is it better to pay off 95% of each credit card debt rather than 100% in terms of your credit score?
So when it comes to revolving credit, like credit cards, the model is looking at it in a couple different ways. So we're looking at kind of like your total revolving debt or revolving utilization ratio. So if you have several credit cards with balances on it, we'll look at it in total across all those credit cards. But then we also may look at it in terms of like number of credit cards that are whatever 50% greater utilized. So if you have additional resources or funds and you want to pay down revolving debt as a means of increasing your score, the best approach would be is if you have any credit cards that are currently delinquent and you have a balance on them, is to get those current. Then the next line of defense or approach or strategy would be, if you have several credit cards with balances, is to attack the low balance credit cards first, because your goal is to get as few a lower number of credit cards with a balance. So if you have 4 cards and let's say 2 of them have a $200 balance and the other 2 have like a $4,000 balance, pay off those $200 balance ones first, because then it looks like you have now reduced your number of credit cards from 4 with the balance to 2 with the balance. And then after that, start digging in and trying to reduce the $2,000 balance on the other cards. Just a couple helpful tips on credit cards. One fallacy out there is that closing credit cards will help improve your score, and that's not the case. And actually closing down an inactive unused credit card could actually hurt your score, and it's because of this thing called utilization. So a real quick example of that would be, let's say you have 2 credit cards and you have $1,000 line available to you on each of that, so that'd be $2,000 line available total. And let's say you have a balance of 1,000 on one and a balance of 0 on the other. So you're 50% utilized on your available credit. If you shut down the 0 balance credit card, you get rid of that available line in the model calculation, and now you look like you're 100% utilized because you have $1,000 line and $1,000 balance. So a big message to your audience is, do not close down 0 balance inactive credit cards, because it has no benefit on the score.
Good deal. Good deal.
Thanks, Tom. We have another question from August. He wants to know, what's the difference in using a company for credit repair or someone just doing it themselves?
Right. So if you're having you're feeling a little bit overwhelmed about your credit situation, which happens to the best of us. And especially in this time of COVID-19, I think it's happening to a lot more people, unfortunately, with, unemployment rates at high levels and just access to income being impacted. If you want to seek out guidance, we all see the ads on the internet, especially if you've been cookied and you've been doing searches on, I need help with my credit, and then you see these banner ads come up, is you want to be very, very careful that you're dealing with a reputable entity. And so before signing up for any credit repair help, do your research. If you have a company in mind that you think is interesting, Google them, talk to friends and family or people that may have a know on that. And instead of doing a credit repair organization, you may want to actually reach out to like a credit counseling entity first. And so, like Consumer Credit Counseling of America is a reputable firm. Operation Hope is another example of a reputable firm. So you may want to go the route of working with a credit counseling association versus a credit repair, because typically credit repair will require some upfront fees that they charge, whereas a reputable credit counseling agency will not require that, and they'll work with you, based on what you have. So I'm not saying all credit repairs are bad, but just be very cautious when you evaluate that as an option. And just one last thing too, with COVID-19, I mean, all the lenders in the United States are understanding that this is unprecedented times. And if you feel that you are not going to be able to make payment on your credit obligations because of lack of job or impact of COVID, reach out to the lender. I know wait times can be long on the phone, but they really are wanting to help you out through this difficult time. So don't feel embarrassed. Don't feel like they're going to red mark you because you called. It's really in your best interest to work with them and do it before you miss the payment versus after you miss the payment.
That's great. That's great information, Tom. We have one more question from Johnny. He wants to know, is there a certain percentage of utilization of credit cards should we try to maintain?
Right. So with the utilization, there's not one magical number out there. In general, the concept is the lower, the better. So someone that has, let's say, 30% revolving utilization is going to get more points than someone that has 50% revolving utilization. One little important note to remember about utilization and its impact on score is that lower utilization, having a low utilization, let's say anywhere between 1 and whatever 10%, may actually be more advantageous than having zero utilization. So we've had examples where consumers will pay off all their revolving balances, to zero. And what ends up happening is that actually is a little bit more risky than having a small balance and ratio. And because what the model and the data tells us is that someone is using credit and using it wisely by having low balance is actually less risky than someone that has zero balance. So if you have the opportunity to pay down your credit card debt, that's great, but do it in a way such that you still are using it, in a limited way, and that'll give you the optimal amount of points for that particular attribute or question in the model.
Thank you, Tom. I have a question though. You did mention the mix. So what's the best credit mix for your score?
Right. So with the categories of the score I talked about, the one important thing to remember about the credit mix is it only accounts for 10% of the score, so it's not driving your score. I always like to get that in there just so people don't, focus on it too much. But basically, the optimal would be where you have an example of an usage and paying as agreed on an installment and a revolving type credit. So, having that demonstrated experience of being approved for both installment and revolving credit and making payments as agreed is kind of the best credit mix package of credit obligations that will result in the most points for that category.
Perfect. Thank you. There's another question from August, but I think this may be better suited for Marlena. I know that there's information, but he wants to know, or she wants to know, is there anything you recommend I can read or certification to obtain help with others in educating them on their credit?
Oh, great question. So Freddie Mac actually has a financial education course called Credit Smart. It is free. It's available. So all you have to do is go onto the Freddie Mac website. I can send out a link if necessary, but it will walk you through all you need to know about, from a budget perspective, from how to prepare yourself for homeownership, for understanding even further than what Tom's even said, to understand your credit and financial impact. So that is one program that is actually available free from Freddie Mac. And again, it's called Credit Smart. In addition to that, if you are currently a realtist and you want to learn how to help your community or people out there, you can become certified for Credit Smart as well. And the next class is actually coming up in October to do that.
Yes, I am definitely Credit Smart certified. It has been an awesome tool here in my office. As immediate past president of the local Women's Council chapter and first vice president of Women's Council of NAREB, it is extremely important that we provide that service, to our community in the modules. I mean, I've even taken some of those modules and expressed or given instruction to schools in classrooms. So yeah, those are phenomenal.
They are really phenomenal. And again, like Letitia mentioned, with Women's Council, we definitely utilize the Credit Smart certification. And I know it was a huge part of our financial connection. So we did have instructors to teach from those modules, and it was really a good tool for, and many of the people in the classes, they were so excited to utilize it and to take their books home and study.
Yeah, great books too. Awesome material. Okay, so one of the questions, I think Lawrence has a question about converting over to business credit. And I know, and if that may not be a platform here, but can anybody address the business credit before we move into the tool?
Well, this is Tom. I can talk about it from a credit score perspective. So when you look at business credit, there's a wide spectrum, right? You have, Apple, which is a business, but it's huge. And so the personal credit isn't going to play a factor there. Your D&B is going to play a huge factor there. And then you have like Tony's Pizza Shop, where he owns 4 pizza parlors in the Dallas, Texas area. And he's a small business owner, and he's probably using a lot of his own personal credit to potentially manage his business. So for smaller businesses like that, which is the majority of businesses in the United States, your personal credit is usually considered in part of that assessment of your loan applications as a small business owner. So typically lenders will use a scoring system that includes information about the business like cash flow, etc., that you provide in the application, but they also will pull your personal credit report and use the Fico score in that overall assessment of the business loan that's being requested. So we encourage small business owners to be aware of that and to make sure that they're managing their personal credit as well as they can to be able to get the benefit of a lower interest rate or more credit line when they're seeking credit.
Good deal.
Awesome, right. Awesome. So, well, Realtist Nation, we do have a treat for you guys. So if you have not been on the House in the Car website, this is your chance to get on the House in the Car website with us. And I will be sharing my screen. We're going to show you guys how to use the Fico Estimator tool that is on houseinthecar.com under resources. So I'm going to share my screen with you guys now. Okay, do you guys see my screen?
We can.
Yeah. Oh, good deal. Okay, so I am going to, I'm sorry, I can't, this box is in the way. Let me see if I can move this.
Look, we'll direct you.
Well, I have to make it smaller to see it because this the box is in the way. I cannot get to it.
Go
Let
up
me
just a
see it.
little,
Can I?
down, down a little, over to the right. Look, one, there you go.
Okay, so here we go. FICO score estimator. And I love how Tom mentioned earlier that your score comes from a series of questions, and that's exactly what this FICO score estimator does. So I have the questions up. Tom, do you want to talk about the questions?
Sure. So the goal of the FICO score estimator is to enable someone to kind of self-report their credit behavior. And then based on that information, we try to assess and give an estimate of your FICO score. And so you could use this, to number one, try to answer the questions as they exist in your current credit situation to come up with an estimate of what the score is. And then you could also use it kind of as a planning tool. So, maybe you have some spotty credit history to date, and then you're thinking about getting a new home or a new car in the future, is to say, well, if I look like this in the future, what will my estimated score be? So it has a lot of utility. But again, it is an estimation. It's not an actual, if you do this, you will get this exact score.
Right, so we can go ahead and start with one of the questions. It says, how many credit cards do you have? And just as a scenario, we'll go ahead and type in 2 to 4.
Sure. And so again, the questions here are kind of from the pie chart or the 5 predictive categories I talked about. So then, length of credit history, we're looking into that. So how long ago did you get your first credit card? And Stephanie, I'll let you choose the answers.
Well, because
You're millennial.
I'm over millennial age. I'm just gonna go ahead with 15 to 20 years ago.
You must have got your card when you were in 9th grade.
Hey, I like you, Tom. I like you.
And then, so the score looks at both revolving credit and installment, like a loan or student loan or whatnot. So this question's more about the loan. So same question about when did you get your first loan, which could be a student loan, a car loan, whatever.
15 to 20 years ago.
And now we're looking at seeking credit. So how many credit cards or loans did you apply for in the last year?
I'm gonna say 0 because I have credit cards already, so I haven't applied for anything new.
Right. And then, so that's the question 3 is about applying. Now, how many did it actually open in the last, and yours would be less than 3 months again. Yeah. And now we're looking into the credit indebtedness. So we're getting into the balances. So how many of your loans or cards currently have a balance greater than 0?
Ooh, I'm gonna say 5 to 6.
And then we'll try to get at the actual balance impact. So excluding mortgages, if you have a mortgage, what would be your total balances on your credit cards and loans? And now we're getting into missed payment information. So have you missed payment on a credit card or loan, and how long ago did that take place?
Well, I just recently found out that there was a missed payment on one of my credit cards, and it was in 2019, but it's still showing on there. And I did not know that I had missed a payment. It appears that I paid it a few hours late because it was on the same day. So
a few hours late?
Yeah, it was a few hours. There was a cutoff time. I think it was supposed to be before 7, and I was like, oh, I need to go pay my credit card. And yeah, it shifted the payment to the next day, and that is still showing on my credit report as a missed payment. So I'm just gonna put on here
1 to 2 years ago, right?
Yeah, 1 to 2 years ago.
And then this question would be, how delinquent did you go? And it sounded like you just had a one-time late.
Yeah, so we're gonna go 30 days, even though it wasn't a full 30.
Right. How many of your loan so this is just looking at.
Well, it's 0 now, so
right, because you brought it current.
Mm-hmm.
So this is trying to say of your current credit card, if you think about your cards, how much of your available credit is being used. So if you have like a $2,000 line and you have a $1,000 balance, you're using 50% of your available credit.
I try to keep my balances low. As a matter of fact, I just paid that credit card off that showed that I had a missed payment. So I'm going to go ahead and go with 10 to 19.
That's good. And hopefully you haven't had a bankruptcy in the last.
I have not. Woohoo!
Whoa, whoa. Now, Tom, would you say that's a good score?
Well, it depends on, the lender, but I would say, again, in the upper 600s to mid 700s would be considered.
I'll take that loan. I'll take that loan.
Okay. Oh, look, that's all we needed to hear. That LaTanya would take that loan. I think that does it.
Right. I need a loan now. I'm trying to get an investment property.
Hey, you know who to call.
LaTanya, you know what? I do have a question for you since we're here. We've talked about budgeting, we've talked about credit, and now we're at a 695 to 745. Does that get us a market interest rate?
Well, I would say there's so many factors to go into a credit, into an interest rate. And that's a great question to ask. And yeah, it does have a lot to, credit does play a factor, but even your loan to value plays a factor in terms of your interest rate. How much are you borrowing against the value of the home? So that has a lot, even the product that you're using. Case in point, myself personally, I'm everybody's refinancing right now, right? So I decided to take advantage of this opportunity and do some work around the house. So which means that I'm looking at one of Freddie Mac's products, a renovation loan where I can refinance and have some available funds. So with that particular loan, I'm not going to get the same interest rate as someone who's just doing a straight purchase or straight refinance. So each product has a certain level of risk associated with it. So yes, that does affect your interest rate.
Right.
So yeah, it's more than just credit.
Yes. And can I add something else to credit? And Tom, you did such a great job. Thank you so much. And I just wanted to add some of the things that we look at Freddie Mac are also in what impacts credit score. Sometimes people just have an established credit. So I kind of want to hit home the financial education through Credit Smart that helps you to learn how to establish the credit, because sometimes people have an impacted score that seems lower, but it's just simply because they may have a thin credit file and maybe it's made up of collections or medical bills. And Tom, correct me if I'm wrong, but that's some of the things that we look at. And that's, some of the things that we've seen have been impactful, especially when it comes to the African-American community. Thin credit files is what we see as a driver for the lower credit scores.
Yes, thin files, again, because the model is trying to assess the credit risk of the consumer. And if there's not a lot of information on the credit report because there's one trade or whatever, that gets a little bit riskier. So they do skew lower. But as you indicate, there's a lot of opportunities out there, ways to increase the depth of your credit report. And so, if you're a consumer that's new to credit, you could potentially get a co-applicant loan with a trusted family member, be placed as an authorized user on a credit card. All the big banks and even credit unions offer secured cards, which are reported to the bureau like it look, taste, feel like a regular credit card, even though there's a security attached to it. So there's definitely some strategies that someone with limited credit could follow to try to beef up their file a little bit and get the benefit of that.
When thanks, of course, to the material provided by Credit Smart and then the Fico model, when I am meeting with a potential client, we always have the conversation when it comes back after the lender has pulled their credit report and it comes back that they have a lower score. I ask them to go ahead and go online, pull their free credit report, take a look at the credit report. And so often what we find is we have an individual that maybe 5, 10 years ago, they had credit and they didn't do so well. So they became afraid, they lived in fear, and they just stopped using credit. And I tell them every time, the day that you stop using credit is the day that you just fell off the face of the earth.
Mm-hmm.
And they're looking at me like, what? Well, exactly. You just fell off the face of the earth and you have no way to recover what you did 5, 10 years ago. So now we have to take it, we have to reverse it, and now we have to recover everything that you did 5, 10 years ago. So then people have, it's like, oh, it's like a light bulb. Oh my goodness, that's all I have to do is recover. Whenever someone gets a score, their scores in the 500s, low 600s, I never want them to be afraid. Mm-hmm. Typically, as long as you're not paying things late currently, it is typically something that you've done in the past, and now let's work together and let's rectify it. Which takes me to my next point, or our next question for you guys. There are so many situations and so many times where there is a lower credit score. What is your advice? If you could give a one sentence advice to our consumers that are listening right now that may have a lower credit score, what's your advice to them?
Well, this is Tom. I'll go first. My one word advice is the score is forgiving. And as your new information shows that you're paying as agreed and reducing debt and only applying for credit when absolutely needed, your score will increase. It may take some time. It's kind of like losing weight. You're not going to lose 30 pounds in a day, but it may take some time, but it will revert to a higher score because it is dynamic and it is forgiving.
Yeah, I would totally agree with that. Letitia, you mentioned something earlier, the word fear. Don't be afraid, right? It's kind of like, you go to the doctor and you've been diagnosed with bad credit. Don't run away from it, right? If we have a diagnosis of something, what we try to do is get with a qualified person, right? That can help us go through our credit line by line. Tom mentioned earlier about, the benefits of the pros and cons of hiring a credit repair service versus like a nonprofit. I would totally agree with him. I mean, there are times, and let me say this, we have some phenomenal great credit repair people that can really help you, but just make sure you vet that person. And then, utilize those free services that are always, that are available to you right now. And to his point, you can recover. I mean, credit, we all have bumps and bruises. I mean, I'll just tell a short story, a personal story. I never forget when I was going to college and my mail was still coming to my parents' home, and I had gotten me a Discover card. And I remember my father, took it upon himself to go ahead and open my mail. And he asked me, he said, "What did you discover? What did you discover?" So, again, credit is forgiving. Definitely.
Mm-hmm. Yeah, I would have to say, in line with everything that was said, is perseverance. It's perseverance and patience. It really does. It takes a while, especially when you're younger and you're going through your growing pains and you have to learn some tough lessons. You just have to keep dusting yourself off and keep moving forward, and eventually you will get to the goal.
Yeah.
I agree with everyone as well. Especially for Johnny, who was asking, is there certain percentage of credit card utilization and things like that? And for those that are wondering if you should use a credit repair agency, I remember years ago when I was trying to do increase my credit scores, I actually did it on my own. So you are able to learn and utilize tools that are available to you through the internet. There are templates for letters if you need to write letters. If you sign up for the credit monitoring services, there are some really good services that allow you to do disputes if you have to do disputes, but be vigilant. And of course, it is forgivable. So that those are also great tips.
Perfect, perfect. Now, Latanya, as a lender, do you see this tool useful, the FICO tool?
Oh my goodness, absolutely. I definitely do. I was already thinking, oh, when we finish, I'm gonna go out there and do that myself. No. It's an awesome tool. One thing I would just ask everyone to keep in mind, Stephanie mentioned the use of credit score services. There are a lot that are out there. I personally like myfico.com. I think it comes pretty close to what what your lender is probably going to look like. Now, let me just caution you, because we get this all the time. You'll go out there and use a service to pull your credit, and then by the time you're applying for a home, it might be 20 points lower when we pull it. Okay. So just keep that in mind, that what you have access to is not exactly the same credit score that we're using. Okay.
Gotcha.
But it is a great guide. I think it's very useful in the credit score services. The thing that I like about them, it will alert you. You can set up different alerts. Like if, let's say if there's an inquiry, you will know. Unfortunately, we live in an era of identity theft, right? So these services are great to help protect you against identity theft, because you would be shocked, especially if you're not looking at your credit report on a regular basis. And that's another big piece of advice I will give you. Look at your credit regularly.
Yeah.
Please. Right there, I can't tell you how many times we've had people apply for a loan and they have a house in New York, or they have a boat they didn't know about. So please look at your credit. But to your back to your question, Letitia, yes, I think it is a wonderful tool to utilize. And I also have to give a major plug to Freddie Mac too, because the Credit Smart modules are great in helping you, get on a good track when it comes to terms, or when it comes to your credit.
Speaking of Credit Smart, can you give us the link again, Marlena? There's a question from one of the realtors in the audience. She wants to know how can they sign up to become Credit Smart certified?
So Monica LaCrue is on, and she actually did drop the link in the Facebook chat. So you might have to scroll up a little bit, but she did drop that in there. And just also want to plug in there that when you are ready for home ownership, we actually did just come out with a Credit Smart Home Buyer U, which meets the first time home buyer criteria. It is free as well. I've actually taken it. It's interactive. So it goes along with our Home Possible as well as our Home One 3% down products. So we're evolving and we're meeting the needs to make sure that we can get everyone into home and make sure they're prepared.
Good deal.
Awesome. Tom, there is a question for you also. Someone wants to know, Jill is asking, as far as credit utilization, is it good to use boosters like creditmyrent.com?
So from a revolving utilization perspective, the boosters are more like Experian has a program called Boost, which enables a user to add trade lines to their credit report, like your utilities, etc. And so that trade line would not be classified as a revolving trade line, so it wouldn't have any impact on utilization, but it could potentially increase your score if the utility trade line shows payment as agreed over time.
Okay, if there is nothing else, there's nothing else. First of all, I want to thank our audience. I want to thank Realtors Nation out there for joining us today. As always, it is a pleasure to bring you Super Series and for House in the Car to appear before you. It's always a pleasure to be here. This series is all hands on deck. It takes a village to produce 2 million Black homeowners in the next 5 years. Last week, we brought you different affiliates and initiatives from NAREB. And this week, we're bringing to you the one-stop shop with the tools, the credit, and budget. What we found during House in the Cars research is budget and credit is probably the number one. And I say number one because I am wrapping them up together. I'm wrapping budget in with credit. One does not work without the other. So when people are thinking, oh, I need budget or I need credit. No. It is one. It's budget and credit. It's probably the number one reason for preventing individuals from, with of course, outside of fear, from being approved for a home. So we think that that is important. Bringing you these tools today. Again, it takes a village, and this is a part of our village. I, of course, like to thank my friends for being on, Miss Marlena and Miss LaTanya. When I was president here locally in Houston for Women's Council, they were a part of my team then, and I'm so grateful that they're a part of my team now here on this national platform for House in the Car. Ladies, thank you so much for being here. And of course, Tom, our newest addition to the team. Tom, thank you so very much for being here as well. Do you guys have anything that you want to leave the audience with before we do our goodbyes and farewells?
I just want to say thank you, everyone, for being on the team, being on this call, sharing all this knowledge with our Realtors Nation. Guys, if you are a Realtors out there and you have stories that you want to share for our Homeownership Changed My Life, as well as Millennial Talk Tuesday, please reach out so that we can share your experiences and stories with our audiences and give that knowledge to those who have not purchased homes yet or someone who is thinking of purchasing a home in the near future.
Mm-hmm.
Thank you for having me. I appreciate it.
Thank you, Marlena. Thank you.
Yes, it was a pleasure being here.
Thank you, Tom.
Well, thank you guys. I appreciate the opportunity. And I just say to everyone out there listening, do not be afraid, okay? Fear is not of you. So come Prime Lending, we would love for you to go to our website. If you have any questions about home ownership, I promise you we have loan officers that are waiting there to talk to you. So thank you very much for the opportunity.
Good deal. Thank you. Well, today, of course, we talked budget and credit. And next week, we're going to show you where to get the bag. And that is with their down payment assistance. So, but we want you to budget first. We want you to take a look at your credit. And now we're going to help you secure the bag. See you guys next week on Tuesday. Have a good one.